I'm not going to give a long intro to our next guest, who's been a friend of ours for years. He's the author of Investor Beware, but it's part of our continuing series called Confessions Week, and we're talking about the inside scoop on what's going on when you deal with your broker. You make the introduction.
John Allen, securities litigation attorney par excellence.
Ooh.
And it's great to see you, John.
Good to
Thanks
see
for
you
joining
again.
us.
Nice
Everything's
to be here.
getting better dealing with your stockbroker. Arbitration's down. All the brokers are honest. All the scams in the last couple of years, everything's under control. Things are getting better.
Absolutely. Can I take off?
Yeah, see you later, John. John, how has it gotten? Have we learned anything as clients and as Wall Street, as brokers? Have we learned anything from the last 2 or 3 years?
Well,
from the bubbles, from the running stocks, from the greed, from the several $7 trillion in losses?
Well, let's put it in perspective.
Okay.
There are about $7 trillion just in mutual fund investors in the United States, right? And about, what, 58% of Americans now own stock.
And maybe more.
You know, the highest, and maybe even more, the high, maybe households then. It's the highest it's ever been. And what you've seen is a betrayal of trust. And let me give you an example. You talk about arbitration. Right now, the NESD, the National Association of Security Dealers, which is the largest arbiter of a dispute. If you have a dispute with your stockbroker, your brokerage company, you're going into arbitration. You're not going into court because of a pre-dispute arbitration clause. Anyway,
Why? Because they make me sign it in a new account agreement, and I have no damn choice.
Right, you have to sign it. Okay, so here's the bottom line. The NESD is overburdened with thousands and thousands and thousands of filings of investors who believe they've been defrauded at an all-time high, higher than it's ever been in history, and they're having difficulty just dealing with all of those lawsuits.
And does that include suits being filed now on the mutual fund debacle, or are they yet to come in, John?
There are mutual fund cases pending. A lot of them deal with the B fund share issues, which are, you know, where a broker might put you into a different class of shares, which would create a higher commission if you get out too early. Back-end loaded funds. Okay, and in fact, Merrill Lynch just announced today that they're going to pay $11 million to investors who had been charged too much in A fund shares.
Daria calls that
joking amount.
She calls that shrimp cocktail money.
$145 an investor on average. But you asked me earlier, should we have learned something from this? I think the basic lesson to learn from this is that if you believe that you can put all of your trust and faith in another individual and another entity and just walk away, take your statements, throw them in the trash, stick them in the filing cabinet, and don't read them, you're mistaken. You have an obligation as an investor to be informed, to be aware, to watch shows like the Dolan shows, to read the newspaper, and not just to blanketly accept whatever you're told as pablum and think this is, they tell me this, I've got to believe everything they say. It must be true. And the reason for it is there's always an inherent conflict. When someone's in a position to be able to make the kind of money that you can make on Wall Street in giving advice, sometimes people take the wrong path and they provide advice that's better for themselves than it is for their client, and the client ends up behind the 8 ball.
John, what are the areas where you end up going to arbitration most often? What are the products
currently
that create the biggest problem for investors?
Well, coming off the bubble and the decline in the markets, there was a lot of churning going on. And
churning, which means unauthorized activity or too much activity in my account. Too much commissions.
A broker buys and sells aggressively, and not in keeping with your goals and objectives. And the reason is not to make you money. The reason is so the broker can make a lot of commissions.
All right, let's go from there.
Okay.
So there's a lot of churning.
A lot of churning.
Even now?
Even now. But even more interestingly, I think one of the biggest problems in the bubble was over-concentration, which people don't talk about a lot. And that is not diversify. Let's say you want to be in the stock market. Let's say you want to own stocks. Let's say 75% of your money is in the stock market. You shouldn't have, if 75% of your money is in the stock market, you shouldn't have 60% of your assets in the stock market in one stock, or in one product.
We just had a caller in the last segment, Dolan's On Demand, who has $600,000 in one mutual fund.
That's an example of overconcentration. And for instance, technology was all in vogue. When people had 70, 80, 90% of their net worth in technology companies, and the technology bubble came down, what was their diversification? How did they protect themselves?
Hold on, John Allen. Wait a minute. You're a good enough friend that I can ask you this question straight. How much of the current problems or late past problems are the big G word on our part? Greed. It didn't work out. They gave me bad information. maybe, maybe not. We've got some responsibility.
Absolutely. You hit the nail on the head.
Right.
There was a lot of greed involved. You know, I've seen a lot of people calling me up and saying, you know what, I wanted to get involved in that. I was in value, I was in bonds, I was very conservative, and I took my CD money and I wanted to get into tech.
Tech's bubble,
but the problem is they bought on the top, and they had no provision, either a defense mechanism, either by buying puts or using calls or some strategy to get out. You know, people aren't always right. They can be wrong. But on the other hand, although there was greed, don't forget there were the analyst cases in which these analysts were getting paid by the investment banking side to hype these stocks that didn't have any reality to them.
Of course.
John, before we run out of time, lay out for our viewers what they need to have and keep and do so that if they do discover that something has been done that shouldn't have been done with their account,
They get some action.
That's a great question. That's a great question. Keep all your statements. I suggest that you hole punch them and put them into a file. Keep everything you get, all your communications, your new account form. But probably the single most important document, people don't even know this, is when you open a brokerage account, the broker has a duty under 2310 of the NASD code and Rule 405 of the New York Stock Exchange to know their customer. So what they do is they ask you some questions and they fill out a form. Some brokerage companies have you sign it, some don't.
Don't sign a blank form, John.
Correct. But that form, you ask what the most important document is. That form says what you want, what your risk tolerance is, what your goals are, what your objectives are, what your time horizon is, and that form is kept at the brokerage company. When a broker makes a recommendation, a manager can pull the form and see, is this in keeping with your goals and objectives?
Yeah.
You should have a copy of that form so you know what the broker's relying on for your goals and objectives.
John, we got to run, but we'll see you after the first of the year. We'll see how things go at the end of the year. Maybe we'll do one of our early year programs as we look ahead at 2004, try to stay out of trouble.
Let's all try and stay out of trouble.
John, thanks a lot.
do it.
Best to Cheryl, happy holidays.
Thank you. Happy holidays.
John.
Thank you.